Let's get back to our guests now. Bill Evans, Global Head of Economics at Westpac Bank, and Philip Chan, Director of Shenyin Wanguo Securities. Bill, look, just a little bit earlier on in the program I was talking to Philip about what he expects in terms of the market reaction. You were just telling me during the break there that you're pretty bullish overall on economic growth in China.
Yes, I think the near-term growth rate could get to about 8.5% next year, Oriel. We're expecting 7.8% for the whole of 2012. And we look at momentum in affordable housing. They've already built 4.5 million affordable housing units in the first three quarters of this year, and we expect that to continue. And that's consistent with this view about improving the affordability of housing. We think the infrastructure momentum will pick up once the new leadership group is established. And the drag from offshore that was huge in 2012, I think, will stabilise. We're still looking for Europe to contract, but not as fast a pace as we saw, and that, of course, is a really critical factor for China's growth prospects.
Okay, I want to follow up on those comments about Europe in just a moment. Philip, how bullish are you when it comes to growth in China?
No, we're actually more or less in line with what Bill says. I mean, we're looking for just over 7.5 for this year, and probably about 8 for next year. This is all subject to, obviously to refinement as things go on. But the recent PMI numbers have been showing reasonably good positive upticks in exports, other things, retail sales. But it's been a fairly mixed bag of results, and so. It's very difficult to conclude that you're going to see a robust recovery just now. But having said that, I think that 7.5 to 8%, these have to be looking reasonably good for economies of this size. So I think this is what the norm is going to be in future.
Based on that, and based on the fact we are seeing a leadership transition, what sort of change can we expect? I mean, is it the consumption plays that you're looking at the moment in terms of making money in China over the next few years?
Yeah, I think we would be looking at the you alluded to healthcare, pharmaceuticals. We'd be looking at these stocks, and also in the short term the utilities, power utilities, and the consumption side. But from time to time, as people get more bullish on China, obviously the export-led type of economy, I mean, that's not going to go away short term. So obviously there will be plays on the commodities again in the short term, but not right now. That's all. I think that once we see more sustained sort of recovery in the economy, then we'll start getting more speculation on the sort of more beta type sectors.
Yeah. Okay. Well, stabilisation in the global economy. And you were just talking about Europe. We've got the fiscal cliff, of course, happening in the US as well. I mean, stabilisation is definitely not around the corner, is it?
No, certainly I would expect that growth in Europe will register another negative this year, but we expect that for 2012 the number will eventually come in around -0.8, which is a lot more than people are currently expecting. We're looking for a pretty poor fourth quarter. So if it only contracts by about 0.5 next year, then that will tend to mean that there'll be some stability in terms of China's external position.
What about the fiscal cliff in the US?
Oh, look, I think we all accept the fact that they'll go over the cliff and then they'll come back with some adjustments. The way that I look at it is which are the ones that are going to have the biggest multipliers. And of course, I think on the tax cut front, if people have to pay more tax, and that possibly doesn't have as big a multiplier as the spending side and the payroll tax side. So I would expect some compromise on tax that won't do as much damage, particularly if the president gets his way on the higher income tax hikes. I don't think that'll do a lot of damage to the economy. But if we were to get rid of the spending, deliver on those spending cuts, particularly the non-defence spending cuts, or to raise the payroll tax again, I think that would be quite damaging for growth.
Okay, something that we're watching very closely. Bill, it's been a pleasure to chat to you today. Thanks for joining us.
Sure.
And Philip, very good to see you.